Hello, my name's Stu Wisson and welcome to financialspreadbet.com. Now here today we're going to talk about just what the stock market and what the stock market is. Now we've all heard of the stock market. In fact, hear it on the news, we can't basically escape it. Daily we are shown values, the FTSE falls 3%, the New York Stock Exchange falls by 2% and so on. That to many probably don't mean a great deal, but in actual fact do reflect the current state of business of a country as a whole, in one broad but not so accurate barometer, as you'll learn more about later. What then is the stock market? Well, first of all, the term stock market also means the equity market too. Both are one and the same thing. Essentially, the equity or stock market, take your pick, is in fact a real public entity consisting and a somewhat loose economic network for transactions of physical stock, equity, in a public listed or incorporated company, PLC or Inc. An open market for the sale of purchase of stock in household companies such as, say, Apple, Microsoft, Google, Tesco, Sainsbury's, Exxon and more. This stock is a portion, a share, of a company which has limited shares to sell. The demand for a stock based on the expectation of a company's current and continued success or failure drives the value, or more to the point, partly perceived value for the stock of that company. Now the sole and primary aim of any stock market is to bring together buyers and sellers that trade between themselves for the given stock in their market. For example, those trading on the trading floor in the London Stock Exchange will primarily be trading UK-based stocks. Those trading in the New York Stock Exchange will be trading mostly US-based stocks. However, it doesn't mean that a trade in London or a trader in London can't buy or sell stock from the US market or vice versa. More so, there are primarily stock markets based in every main city around the world, because each country has public listed companies where there is a demand for sale or purchase of that company stock. One key point to understand about the stock market is that these days it's not just the sale of company stock in the terms of true exchange. Yes, this was and still is the primary aim, to provide a central location of the sale and or purchase of the company stock. However, over the last few decades, and in fact more so in the last, say, 15 years or so, there has been an incredible rise in the use of derivatives, which are also traded in the same way in the same markets. Now, derivatives are a means of creating a financial product, a vehicle, based on a true actual product, which is known as the underlying. Look at it this way: a derivative, for instance, could be based on the FTSE 100 index, either by being above the previous day high or not. Therefore, traders would trade, or essentially gamble, whether the market was higher or lower than the previous day. The actual product they trade is the derivative, as it's derived from the value of the FTSE 100. But unlike the equity market, it holds no true value. It's trade based on a notional value that has a true or false result, nothing more. Now this is an example, a quick one, of what a derivative is, and there are many, many more. In fact, as an aside, it was the derivative markets in the subprime mortgage sector in the US that began the decline in the financial sector in 2009 onwards. The London Stock Exchange trades between, say, 8 a.m. and 4:30 p.m, with the final end of day price of all stocks taken at 4:35 p.m, to allow for the final amount of trades to trickle in and be counted. Now those trading the markets, as is known as a whole, are retail investors, the general public, you and me. Institutional investors that manage anything from banking, hedge funds and insurance, for example. Many pension funds are managed and traded in and out regularly in the stock market. Even companies will either purchase its own stock or that of other companies to take advantage of tax breaks and financial reserves that it may hold. For example, we have seen many times Apple purchase its own stock back with its cash reserves, or purchase stock in other companies with a view of taking on a strategic market share of that company. Now the stock market, or the stock exchanges around the world, are traded much the same way. In fact, all are computerized these days, such as the volume of trades and the speed of trading that is undertaken. Yet even today, in some of the markets, you will see some traders adopting the old method of buying and selling, known as open outcry. Now, this may not mean anything to you, but I'm sure you've seen it on TV and in one of the most mimic gestures that are made when anyone hears the word stockbroker. You've guessed it, it's the hand signals given across the trading floor to broker sales of stock. The method of sale or purchase of stock is based on the auction model. Now, this is what drives the market for that stock set up or down. For example, we have companies, say XYZ, and the broker is given an amount of stock for sale, and he knows that currently the market for that stock is trading at 100. Yet, he knows that demand for that stock is likely to increase based on any number of factors, from expected profits announcements, or that it's expected to be positive, for instance, or to news and development that the company is involved in, or simply the stock is trending on the open market based on market psychology being positive for that stock. Now, I'll be talking more about market psychology and what really drives the markets in the training course, which is free and on this website, being released very soon. Now, if you want to actually take advantage of that, you can be on our early bird access, which will be alerting everyone to. If you sign up on the right, you'll see a little box where you can enter your name and email address. Now, as the broker knows there is a demand for the stock, he could wait and demand a higher price as the amount of available stock for sale in that company starts to dry up, or he could sell his stock now. Therefore, he could ask for 110 for his stock and wait to see who will be buying at that price. Now, if he gets a good amount of sales, he may start to raise the price quickly. At the same time, there are other traders, brokers, selling and buying the same stock. It is this natural flow of bidding on and asking for prices that creates the market. Now, as I said previously, I will explain later how this actual market is based on market psychology rather than any given physical value. Why then does the stock market exist? Well, aside from the whole speculation on the markets and its derivatives, which really came much later, the whole purpose of the stock market, and still is, as a means for companies to sell stock in itself to raise money for investing back into developing the business. Another example will help here. Any business can become, in our example, a PLC, a public limited company, or an incorporated company, by selling its stock on the open market. Now, there is a great deal of legal and financial work involved in getting to start at what is called an IPO, an initial public offering, which is when the stock is initially auctioned off to raise funds for the company in question. Now, a good example of this is how it can raise a great deal of money based on expectation and market psychology, in that of what was known as the tech bubble or the internet bubble of the very late 90s or early noughties. The internet was pretty new to most people at that time, and it became very much the Wild West again. In fact, I have a lot of personal experience, as during that time I was both a project manager and internet manager for 2 startup internet companies, and also an internet service provider company. Now, to see the money pouring in and then out of these pie-in-the-sky ventures was incredible. Many internet companies sprang out of nowhere. They would start on a shoestring and then go IPO as soon as possible to raise money purely based on an idea. Some of the ideas back then were ridiculous, but because the market was naive and it was seen as a means of speculating, and many of the stocks were rising in value way beyond that of any true value, again, market psychology in action there, the demand for new IPOs and stocks became huge. These new internet companies were raising millions upon millions when they hadn't even, before they had gone IPO, made a single penny. Yet the demand for their stock grew and grew. However, it was only a matter of time before the key investors started to look deeper on the earnings reports that brought no relation to the promises made by the IPO brochure. Within a few short months, stocks in these companies crashed. New IPOs were having problems raising money, and eventually for years to come, any internet-based IPO had trouble raising even the opportunity to sell. Now, this is a good example of how the actual price of stock bears little to no real market value of that company. It is essentially what other people believe that stock is worth and no more, based on the auction of that stock in the stock exchange. Now, even recently, we've seen market crashes led by the financial sector. This, though, was different in that it was led by the It was led by the oversale of subprime mortgages, basically the sale of mortgages and loans to people that had no means of paying them, to which the broker received a commission based on the sale, and the derivatives of that market were incredibly popular as they climbed in value so quickly. Now, no one questioned what would happen if these subprime buyers couldn't pay. Banks and other institutions jumped on board, could see huge speculative profits in the sale of these loans and ever-increasing derivatives based on them. This spiraled out of control till one day, not so far down the line, people started to default on their loans. The banks were exposed, which became known as toxic debt, and banks collapsed. Financial institutions failed, and the whole thing started to become what was the biggest financial collapse since 1929. In many respects, it was bigger, but the reaction by the governments was much swifter by bailing out the banks. Personally, I think this was a big mistake, something which I'll be talking about later in the free course. Now, as we can see, the stock market is a means for companies to raise money, for those involved in the market to speculate and potentially profit from the sale of purchase of stock or the trading of derivatives in the market. It can show that real physical value of a company is rarely represented in the stock price, and how this expectation can lead to catastrophic gains and subsequent losses, plus how even the banks that we love or loathe can in fact cause market collapses. Now, in the stock market and other markets related to the banking sector, and how that has cost every man and woman thousands of pounds in taxpayers' money per person to bail out the banks and institutions.